Mic check. 1 2 1 2. How we doing? How y'all doing? All right. Welcome to the Ironworth Trading 5-day trading challenge. It's actually been a challenge for me delivering it because it's my first time doing something like this, but it's okay, y'all. Bear with me. Now, if you watching this and you blew an account before, okay, or maybe you watching your portfolio do some shit to you that you didn't plan for, right? I need you to pay attention. Today, more than any other day this week, day 1 was about reading the market. Day 2 was about finding the best setups. Day 3 was about entering, exiting, and placing your stop the right way. But none of that matters. And I mean none of it if you don't know how much to put on the line when you actually pull the trigger. Okay? So most traders learn everything about how to get into a trade, but nobody teaches them how much of their account that they should actually risk when they do. That is why today is the most important lesson in this whole challenge, all right? Day 4, position sizing and risk management. Let's get into it. All right. We on the 5-day challenge, right? So if you just now joining us, I'm Coach Price, and this is Ironworth Trading, and we in the middle of a 5-day series that is designed to give you a complete system, starting from zero, all right? But this is where we've been. On day 1, I broke down price action and how I actually read the chart, what's moving the market, what's the noise, and how to stop guessing and start observing. Day 2, I went live on TikTok and gave people the 5 pillars of a high probability setup: trend alignment, key levels, candle confirmation, volume confirmation, risk to reward ratio. And at the end of day 2, I introduced the setup quality score. This is a way for you to grade your trade ideas before you ever touch your account. Day 3, we got a little surgical. We talked about entry triggers, exit rules, and then the one part that most people skip, which is where to actually put your stop loss at, not where you'd hope the price will go. But I learned that a lot of people is not making it to these TikTok shows, so I brought it back over to WAP. Figured I'd put them on YouTube because that's the most efficient way. So going forward, I'll just drop the show on YouTube and then I'll paste the replay into WAP or into the Discord. Okay. Now today, day 4, we're building the risk engine that holds all of that shit together. Because to be honest with y'all, you can have the best setup in the world, you can enter it perfectly, and you still can blow your account if your position size is wrong. All right. So the size is where the discipline actually lives, and discipline is what separates people who stay in this game from people who quit. All right, and then tomorrow, day 5, tomorrow I'm doing something I don't normally do in a free challenge. I'm going to walk you through a live trade review. Real chart, real decisions. I'm going to show you exactly how everything we covered this week comes together on a single trade. That's tomorrow. Don't miss it. Right now, we got work to do, right? We got work to do. All right, now. Let me see. Maybe I could fix this screen a bit. Nah, that's it. That's about as much as I'm going to get out of it. All right, it's cool. Excuse me. Maybe I can fix the... Maybe I can zoom out a little bit, y'all. Give me a second. Nah, it didn't work. And I don't have time to waste playing with this shit, so. Yeah, fit to screen is going to have to do. Which is fine for right now. That's cool. So look, I want to say something that's going to contradict everything y'all been told about why traders fail, right? It is not bad entries. It is not bad exits. It's not picking the wrong stock. The number one reason why they blow their account is that they don't know how much to risk on a single trade. And because they don't know, they size up based on emotion instead of math. They feel confident, they go big. They feel scared, they go small. And then their position size, basically how much dip they put on a chip, that follows their mood. How much they put into a trade follows how they feeling. And your mood is not a risk management system. All right, so let me paint y'all a picture. Trader A got 10 bands in their account, 10,000. All right, they see a setup that they like, they feel good about it. They put $4,000 into a trade. That's 40% of their account. The trade hits their stop loss. They just lost $400 because at least they had a stop, right? But the next day they see another setup and they feel just as good, so they do it again. Same 40%. This time the trade goes against them fast and they just panic. They don't take the stop loss. They end up losing, let's say, 1,200. Two trades, they down 16% because of sizing, not because their setups was wrong. Let's look at Trader B. Trader B got the same $10,000, but they use a rule. Okay, they risk 1% per trade, $100. The same two trades happen. The first one stops out, they lose $100. The second one, they panic and don't take the stop, they lose $300. Same emotional mistake. Two trades down 4%. Same market, same mistakes, different outcomes because they had different position sizes. You understand what I'm saying? This is not a small gap. That's the difference between being in the game in month 3 and being broke in month 3, right? Now, what I really, really want y'all to understand is position sizing is not just about surviving. It ain't about survival all the way. It's about your mindset, your psychology. So when your position is too big, every single tick against you is going to feel personal. Your breathing changes. You start making decisions based on what the position is doing to your emotions, not what the chart is telling you to do. You start negotiating with yourself. I'm just going to wait for it to come back. Like, that's how a $200 loss that you plan to take end up becoming a $900 unplanned one. All right. Now, when your position is correctly sized, something different happens. You can actually watch the trade. You can observe the price action and respond to it. You can take a stop without it destroying your day. You can take a win without feeling like you need to immediately double down and make it count. All right. The right sizing is what's going to give you the mental space to actually trade like a professional. All right. Now, I said this before, I'll say it again. Trading is 80 to 90% psychological, 10 to 20% mechanics and technical analysis, okay? And nothing in trading touches your psychology harder than position size. Nothing. Before I move into the math, though, I need you to notice something. We on day 4. Y'all been with me all week, and I've been giving you the frameworks that build on each other. That's intentional. I'm doing it on purpose. Because at the end of tomorrow's session, I'm going to end up opening up something for the people who want to take this beyond 5-day challenge. All right. I have a premium membership, Ironworth Trading community on Discord, where I teach stuff like this every single week. We do live trade reviews. We cover new concepts, and you get access to my full trading curriculum, not just 5 days of it. If that's something that you want, stay locked in through tomorrow, because I'm going to break down exactly what that looks like and what's available. But let me get back on track, because right now we got to talk about the math. Now, the 1% rule is simple. On any single trade, you do not risk more than 1% of your total balance. That's it. That's the rule. All right, before y'all tell me, Coach Price, 1% too small, stay with me. Stay with me. Because the 1% rule isn't about limiting your gains. It's about controlling your exposure. You can still make a shit ton of money with the 1% risk, with risking 1% per trade. I'm going to show you exactly how. But the formula: account balance times 1% equals maximum dollar risk per trade. The dollar amount is not how much of your account you're putting into the trade. Let me say that again, because this is where most people get confused. The 1% is how much you are willing to lose on the trade. It is the distance between your entry and your stop loss multiplied by your number of shares. That dollar amount cannot exceed 1% of your account. Excuse me. Okay, account balance, 5,000. 1% of 5,000 is $50. That is your maximum risk per trade in a $5,000 account. So now let's say that you're looking at a stock trading at $25 a share. You've identified your stop loss at $24 a share. That means that you're risking $1 per share. All right. Now, if you trade in options, let's say you think it's finna go to $30, but you saying if it go down to $24, you're gonna get out the trade. My point is, you're risking a small amount. So you buy, some of y'all could buy 50 shares at $25 a share. Your stop is at $24 a share. So if it go down to $24 a share, it's going to automatically sell. You lost $50. That's 1% of your account, but you controlled it. All right. It was known in advance. Now, let's say your target is $27.50. That's a $2.50 potential gain per share. $50 or 50 shares times $2.50 equals $125 potential gain. You risk $50, you were rewarded $125. That is a 5 to 1 risk to reward ratio. That's solid. It's a 2 to 1. We covered why risk to reward ratios matter, so that should feel familiar. But yeah, I mean, basically, y'all, you want to lose a little bit every time you take a loss, and that way one win will wipe out a lot of small losses. You understand? That's why your losses need to be small. That is why the 1% rule works for every account size. It's not a fixed dollar amount, it's a percentage. So it shrinks when your account shrinks and grows when your account grows. It's self-adjusting. It protects you when you're losing and naturally scales you up when you're winning. Now, some of y'all looking at me through the screen right now thinking, Coach, $50 a trade. I'm trying to make some real money. I hear y'all. Now, listen closely. If you have a $5,000 account and you frustrated with $50 risk limits, you got two options. Number one, you can grow the account responsibly so the 1% becomes a bigger number. That's the right answer. Number two, you can risk more per trade to try to get a lot of, more money faster. That's how people blow their account, though. And then they have $0, not 5,000. Okay, impatience is an account killer. That 1% is not a ceiling; it's a floor that keeps you from falling through. And I tell y'all something else too. The traders I work with on a one-on-one basis, and I do have a limited number of one-on-one slots available right now. The first thing I do with every single one of them is audit their position size, and I want to see how they trade. Not their strategy, not the indicators, their sizing. Because 9 times out of 10, that's where the bleeding is coming from. Now, if y'all been struggling and you want somebody in your corner going through your actual trades, your actual numbers, your actual psychology, that's what those sessions are for. I'll say more about that at the end of today's lesson. But for right now, I need y'all to overstand with me loud and clearly. All right. So, yeah. Here's where things get interesting. Let's talk about day two. Day two, we talked about, I introduced a setup quality scoring system. I was teaching people how to score something that is a good trade, right? So, we're going to break that down real quick. So, score 5 out of 5. I mean, full size. This is the cleanest setup available to you. Everything lines up. The trend is right. The level is right. The confirmation is there. Volume backs it up. And the risk to reward is strong. This is the trade that you've been waiting on all week. This gets your full 1% risk allocation. Score 4 out of 5, 75% size. It's still a high probability setup. One pillar is weaker than you'd like, but yeah, the overall structure is solid. You trade it, but you reduce your exposure slightly. If your 1% is $100, you risking $75 on this one. Now let's say the trade that you're looking at is giving you a score 3 out of 5. So I'm risking 50% of that, or I'm just gonna pass on it. At this level, a lot of experienced traders simply skip the trade. If you do take it, you cut your size in half. You use half of what you would normally use. You acknowledging the lower quality of this trade with the smaller amount on the trade. Okay? Now, I know y'all can't see. Man, I don't know what I did. I don't know how I can fix that to where y'all can see the bottom half of this. So I apologize for that too, y'all. This is my first week doing one of these. I will get better. Okay, but the second one, number 2, says if it gets a score 2 or below, no trade. Just don't even take the setup. So it's okay. Now, why does this matter? Because all of these setups are equal, and your position size should reflect that. because I meant to say not all of them are equal actually, but your position size is going to show that. The 1% rule keeps you from blowing up on any single trade, but the quality scoring is going to keep you from treating a mediocre setup the same way you would treat a grade A setup. Now, there's a mindset benefit from that too, because when you got a framework for this, you stop convincing yourself that every trade is a 5 out of 5. Oh, this is a good trade. And you're going to be surprised how honest you get with yourself when there's money attached to the score. All right. If you inflate the score, you oversize, and eventually the market going to whoop your ass. It's going to punish you. But when you score honestly and size accordingly, you will find your biggest wins come on your biggest positions, which comes on your best setups. That's alignment. That's what professional risk management looks like. Your biggest position should be on your best setups. That's what alignment looks like, y'all. Let me see how do I get this back up here. All right. And listen, this is one of the concepts that sounds simple until you try to apply it in the middle of a live session when a stock is moving and your emotions is running hot. That's why the live trade review tomorrow is important too. I'm going to show you how I actually score a setup and size it in real time, not in theory on a live chart. That's tomorrow. All right. Now, most people who learn the 1% rule, they stop there. And that's a mistake. The 1% rule controls your risk per trade, but a disciplined trader also controls their risk per day and their risk per week. Okay, these are different layers of the same risk management system, and you need all three. You need all three. We just covered this. 1% of your account is the maximum risk that you take on any single position. That's your micro level protection. It keeps any one bad trade from doing serious damage to your whole account. But we also got your daily circuit breaker, right? So if you have a $10,000 account, a 2% daily stop means that once you lost $200 in a day, across all your trades combined, you close your platform, you're done for the day, no more trades, full stop. Because bad trading days can compound on you. You take one loss, your emotions kick in, you trade to recover it, you revenge trading, you take another loss, and now you're down even bigger and you're emotional and the spiral begins. The daily stop will prevent that spiral from ever starting. Most professionals use somewhere between 2% and 3% as a daily maximum loss. I personally recommend 2% for newer traders because the emotional response to losses is stronger before you've built consistency and confidence, right? So you can adjust as you develop. The risk per week, same principle, but a broader window. If your account is down 5% for the week, that's your signal to step the fuck back, look at your trades, and figure out what's going on, what you're doing wrong before you continue. You don't got to give up. But if you having weekly losses above 5%, that almost always indicates one of three things. Either your setups wasn't strong as you thought they was, or the market conditions changed and you didn't adapt, or your emotions was driving decisions that your rules should have been making. A weekly review forces you to diagnose the problem instead of you just continuing to fucking bleed. And think about this, y'all. If you using this 1% rule correctly, you have to lose 20 trades in a row to lose 20% of your account. That's almost impossible if you are using the scoring system from day 2 to only trade quality setups. The system protects itself when you follow it. This says the Ironworth pre-trade checklist. All right. I know you can't see the bottom half of the screen, but it's okay. I'll read it to you. I promised y'all something that you could use immediately. Right here it is. Before you take any trade, you run through 5 questions in order every time. Question number 1. What is my account balance right now? Not what it was last week. I'm talking about right now, today, live number, because your position size is calculated off of your current balance, not your starting balance. Question number 2, what is 1% of that number? That is your maximum dollar risk for this trade. Write it down or have it ready. That's your limit. Question number 3, what is my entry price and where is my stop loss? The distance between those two numbers is your risk per share. You need this number to calculate. You need it. Question number 4, what is my setup score? Run the 5-pillar scoring system. Score it honestly. Then apply the appropriate size modifier like 100%, 75%, 50%, or no trade. I'm not going to trade it if it ain't a good setup. And then the last question is, what is my risk to reward ratio? If your setup score passes, but your risk to reward is below 2-to-1, you got a problem. That means you got to damn near win half your trades just to break even if you don't do this part right. So either your target isn't realistic or your stop loss is too tight. Fix it or skip it. But if y'all can answer all 5 of them questions clearly before you enter a trade, you are already operating at a high level than the majority of retail traders. Most people just click buy and then they figure out the rest later, but that's gambling. This is trading. All right. I'd highly recommend putting this checklist on a piece of paper. I will provide it to everybody in the Discord and the WAP. Go ahead and join. All right. I'll provide the entire show to you. Now, averaging down. Let's talk about averaging down real quick. This means averaging down means your trade is going against you, and instead of honoring your stop loss, you buy more shares at a lower price to bring your average cost down. People do this thinking that they being smart, getting more shares at a discount or more contracts at a discount, but what they actually doing is increasing their exposure to a trade that they are already fucking losing in. That's the problem. So you set your stop loss for a reason. The price level told you that the thesis was wrong by hitting your stop loss. But when the stock hits that level, a trade is usually over. Adding shares at that point isn't conviction, it's denial. I've seen traders with solid risk management turn a $150 plan into a $9,000 loss. I swear, y'all, 9 bands was what it supposed to have been a $150 loss because they averaged down 3 times before finally giving up. The stop is a promise that you make to yourself before the trade starts. When you average down, you breaking that promise. So if a trade isn't working, your job is not to double down on it. Your duty is to get out cleanly. Pay attention to it and figure out what happened and be honest with yourself. Assess it honestly. And then you want to wait for the next quality setup. Your stop is a promise that you make to yourself before the trade starts. You need to honor it. Revenge trade, and I don't got to say much on this one. Y'all know you take a loss, it stings. You immediately open another trade to try to win it back. That's revenge. I'm gonna say this, and I'm gonna leave with revenge trading alone. The money that you lost, you will never get back. You will never see that money that you lost again. Now, the money that you do make is gonna be new money. It's not the same money that you lost. So just stop thinking that you can make the money back. You're not gonna make that money back. The market doesn't owe you a recovery trade. The market doesn't even know you lost money. It is just moving. And if you're chasing something, it's going to run from you. It's going to take more from you. All right? After losing a trade, y'all, step away from the screen. I was finna cuss y'all out. Step away from the screen for at least 15 minutes. Review what happened. Was the loss in your plan? If so, that's fine. It's just a part of trading. If no, what broke down? You didn't follow one of your rules. I'm going to go to the next one. The win streak trap. The false sense of confidence right here. I seen too many fall for this one. You string together 3 or 4 winners. You done won 4 trades. Now you feel invincible. The market is speaking your language, so you decide that the next trade deserves a bigger position because you feel like you need some butter because you on a roll. Excuse me. But you feel like you earned it, right? This is one of the most seductive mistakes in trading because it feels logical. You winning, so you press, and then here's what actually is happening. You are using your recent emotional state as your risk signal instead of the math. The win streaks that you had do not change the probability of the next trade. Every trade is independent. The market don't give a fuck that you won 3 trades in a row. It don't even know. So when that oversized position hit a stop loss, which it eventually will, it doesn't just erase a normal loss, ladies and gentlemen. It can erase multiple wins in a single trade. The rule is the rule whether you up 5 trades or down 5 trades. 1% every time. That's the rule. But it's also your protection against your own confidence. The 1% rule is also your protection against your own confidence. If you size up after a win streak, the market is going to get back what you took. Don't give it back, y'all. I've been doing this challenge this week, and I'm gonna keep doing these, right? I genuinely believe that everyone who wants to learn how to trade deserves access to real information, not just highlights. So I also know that information alone doesn't close the gap for everybody. So some of y'all need more than a YouTube video. You need somebody who's gonna sit down with your specific trades, your specific account, your specific psychology, and tell you exactly what's working and what's costing you money. That's what I do in my one-on-one sessions. I currently have a limited number of 1v1 coaching slots open. They are not group calls. These are direct sessions with me where we review your trades, we audit your risk management, and we build a plan specific to where you are and what you're trying to do. If you're the kind of person who learns better by doing it with someone in your corner, these sessions are for you. I'm going to drop the information on how to book it at the end of today's show. It'll be in the description of this video. But the slots are limited and they fill up. So if you've been thinking about it, don't sit on it. Now we're going to bring this home. Today we covered 5 big ideas. We cover 5 big ideas. Number 1, position sizing is the number 1 reason traders blow account, right? Not bad setups, not bad strategies. The number 2, the 1% rule is going to give you the formula to size every trade correctly, regardless of account size. Account balance times 1% equals your maximum dollar risk. Divide that by your risk per share. That's your position size. Y'all can roughly estimate that shit if you don't want to do all that calculating, but just make sure you keep your losses small and stop putting all that damn dip on the chip. Number 3, your setup quality score from what I taught y'all is your permission slip. If it's a grade A setup, it gets a full size position. A grade B setup gets 75%. A C setup gonna get 50%, or you gonna leave it the fuck alone. A 2 or below is not a trade. A D or F is not a trade. Number 4, you need 3 layers of risk control, y'all. You need to have a certain amount that you're going to lose per trade, a certain amount that you're willing to lose per day, a certain amount that you're willing to lose per week. Those 3 levels are your full risk management system. And number 5, the behavioral mistakes will undo all of it if you are not disciplined. Don't average down. Don't revenge trade. Don't size up because you feel good, all right? Y'all with me? I'm asking questions like this a live stream. So yeah, tomorrow's day 5, the final day, and like I said, I'm doing something that I don't normally do in a free challenge. I'm going to walk y'all through a live trade review, a real chart, a real setup, and I'm going to narrate every single decision that I would make in real time. Every entry trigger, stop placement, size calculation, quality score, the whole thing. So you're going to see this entire week's curriculum applied to one trade. And at the end of tomorrow's session, I'm opening up my premium community for the people who are ready to go further than 5 days. All right. Now, again, this is a community where I work with serious students on a recurring basis. We go live most of the time on TikTok, but I cover new concepts. I do live trade reviews. I answer your questions in real time, and you get access to my full curriculum, not just a 5-day challenge. This is for the people who want to build this into something real, not just learn about it. All right, I'm going to break down everything that's included tomorrow, and you will have a chance to join right then. So if y'all been watching, you thinking this is exactly what I've been looking for, tomorrow going to be a good moment for y'all. All right, it'll more than likely be on TikTok too. But I'm Coach Price. You've been watching day 4 of the Ironworth Trading 5-day challenge. You don't need to catch every move. You need to only trade the best ones. All right, get your rest. Well, actually, get ready because the market just opened. Have a good day, y'all. Adios.